Now, the real estate market across the nation has been on fire in the last 10 years due to the high demand, growing populations, and the inflations and etc. I mean, if you have purchased a property in one of these expensive cities like LA, San Francisco Bay Area, New York, Boston, Seattle, and etc., 10 years longer, well, congratulations. I mean, you've made a lot of money by now in 2022. But besides your friends and families, who's going to be happy for you? The government, the IRS, is also going to congratulate you. And we all know what that implies. Yes, it's the capital gain tax. Hello, everybody. My name is Bojie. I'm a Bay Area real estate agent, been selling in the Bay Area forever. Today, I want to talk about the topic of capital gain tax deferral and what are some good options out there for us. Now, speaking of tax deferral, the first thing that comes to mind is 1031 exchange. Basically, buy another like-kind property in 180 days. Basically, 45 days to identify the property and 180 days to close. But in a hot market like what we have in 2022, you as well as I know, there's literally no properties to buy. And every property that we're looking at, we're also looking at multiple offers. So 45 days is really not a whole lot for us. Besides that, what if I own a primary home that I purchased 20 years ago? And you as well as I know, in markets like Bay Area, LA, Seattle, that could mean my property has already appreciated over $1 million in the last 20 plus years. What if I want to sell and retire and move to a cheaper place? Well, I have a lot of trapped equities in the house. What do I do? Well, today I'm going to share with you a different tax deferred strategies besides 1031, and that is more flexible than 1031, and it's called DST, the Deferred Sales Trust. Now, before I get into it, just a quick disclaimer. Now, the content of this video is for information purposes only. It's not intended and must not be taken as legal advice. Viewers should seek legal consultation before taking actions. Now, all right, let's get into it. Let's take a look at the property capital gain tax in California. Using an example, say we have a property with $1 million capital gain in California. What we're looking at is typically 20% gains to the federal tax, and California state tax will be 13% ordinary income. And number 3 is depreciation recapture. This could be up to 25%. And the number 4 will be the Obamacare tax, 3.8%. In short, if you own a highly appreciated real estate property in California with $1 million in capital gain, you could be roughly paying around $300K to $400K in taxes. That's a lot of money. When it comes to deferring their real estate tax, most of the investors know about 1031 exchange, and that's the most common deferral strategy. And the issues with the traditional 1031 exchange is, number 1, there's time constraint. You have 45 days to close to identify the property and 180 days to close. That's not a lot of time. And number 2, it's risky. Statistically, about 20% of the 1031 exchange deals falls apart for reasons such as the financing falls apart, or the negotiation didn't come through, or there's new issues being discovered in the property. And it could be a lot of unknown that we're dealing with. Number 3, traditionally, we like to buy low and sell high, but with the traditional 1031 exchange in the rising market like we have, we're forced to even buy higher, which is not very popular idea among a lot of investors. And last but not least, the issue with traditional 1031 exchange, it only applies for investment homes. If you own a primary homes in California that has appreciated a lot, you're simply not qualified to do 1031. So the first sales trust, let me give you a quick intro on how that works and what that is. First and foremost, Deferred sales trust is a tax deferral strategy based on installment sales with the IRS tax code of 453. It is designed by Campbell Law with 20 years of history. They are approved by the IRS and FINRA and etc. Thirdly, over 3,000 cases and perfect track record with the IRS. So it's a completely legitimate and battle-tested way of deferring capital gain tax. Number 4, it's a proprietary product. Currently, there are only a dozen certified companies around the country are allowed to service their clients with deferred sales trust setup. And last but not least, deferred sales trust strategy can be applied to all United States assets, not just investment real estate property, which makes this strategy so powerful. Now, to help you understand why installment sales is in a tax deferred state, let me explain to you the two basic requirements that trigger the tax on your income. So the first one is if the money is earned or gained by you. And the second trigger is if the money is in your possession. When both are met, your tax is triggered. For example, if you're getting a loan, then the money is in your possession, but the money is not yours. It doesn't belong to you. Therefore, you don't pay tax on the loans. On the other hand, if the money belongs to you because you earned it, but the money is not going to your personal bank account, but instead it's in your 401k account, then you don't pay tax until you decide to withdraw it. So with that understanding, as you can see, the installment sales is basically a way of collecting your sales proceeds over a period of time in order to avoid a huge tax lump sum at the sale of your assets. Smart investors will want to consider that to minimize the tax bracket and to generate more income while the proceeds is being deferred. So what is the difference between the traditional installment sales, or we call it seller financing in real estate, versus a DST? So the installment sales for seller financing, there's a couple of pros. The first one is, it's legitimate. It's been there. It's been around for 90 plus years. So it's completely legit and recognized by the IRS, 453, like I said. And number two, it's an alternative way of selling difficult properties. I mean, there are certain properties that are tough to sell, for whatever reasons. Buyers cannot obtain traditional way of financing, then paying this property in installment, such as using seller carry, can be a pretty good way of moving these difficult properties. Thirdly, the seller can have an opportunity to earn a higher interest return while the seller is lending the money to the buyer. Last but not least, seller is doing it mostly to defer capital gain tax, which is the subject that we're talking about. And the cons right here, number one, there's a cost of negotiation. Typically, in a deal like this, where buyers and sellers have their own agenda, usually neither buyers and sellers are going to get 100% of what they want. A lot of times, both parties will have to compromise on terms and certain criteria and meet halfway. So the cost of negotiation will have to be factored in. Secondly, buyers in situations like this always has the leverage because buyer owns the property and it's entirely up to how buyer wants to pay and how they're capable of paying over the next period of time. Thirdly, seller is not diversifying enough of their investment because all of the seller's money are tied up still in this property until the seller can get all their money back. And of course, there's always a risk of buyer paying off early. What if the buyer decides to refinance, or if the buyer could refinance, and then the seller gets all the money way too early and start triggering on the capital gain tax. So that's always a risk that the seller will have to consider. So for the deferred sales trust, it's a flexible, low-risk way of deferring trust tax, and it gives all the controls back to you, the seller. Let's talk about the schematics of the DST and how it works. And you are the taxpayer, investor, and the seller in a situation like this. And let's say you have a total $1 million worth of asset. It could be a real estate property, cryptocurrency, commercial property, what have you. And now, let's say, a third-party DST trust is set up and it buys your asset for $1 million. In return, what you, the investor and the seller, is going to get is $1 million promissory note. And so the property goes into the trust, and now the property comes onto the market, and there's a cash buyer with $1 million ready to buy your home. And after this transaction, the property goes to the buyer on the market, and the DST trust gets $1 million. And on this particular section, there is no capital gain tax being triggered. Why? Because the DST trust purchased the property from you, the investor, for $1 million, and the property is now sold to buyers on the market for $1 million. So 1 million for 1 million, there is no capital gain right here. So now that the money is in the DST trust, there are two options typically for the seller or the investor. First, the seller can start withdrawing money from the DST. How much you want to withdraw, how frequent you want to withdraw, and how long you want to withdraw is completely up to you, depending on what tax bracket you want to be, and so on. Second choice, which is more popular, is the sellers start investing the money they're sitting in the DST as a pre-tax money into other money market and earn them an interest incomes. And no matter whatever way that the seller and investor decide to choose, the seller has complete control and there's no timeline pressures. Let's compare DST versus 1031 exchange. So there's a lot of differences between the two. With DST and 1031, the DST has no time pressure. And we all know with 1031 exchange, you have 45 days to buy and 180 days to close. With DST, seller decides what to invest. Investment options are quite broad and there's a lot of choices. But with 1031, you can only reinvest in real estate because 1031 is a real estate specific tax deferral. And thirdly, DST is highly liquid. It's easy in and easy way out. With 1031, on the other hand, the liquidity is lower because the money is tied up in the property. Or if you're doing a Delaware exchange, then the money would typically be stuck in the Delaware for 5 to 10 years. Fourth, DST has relatively lower risk because its investment flexibility. It provides more diversity, and because of that, the risk is typically lower. With 1031, the risk can be higher because you're trying to exit the market, and with 1031, you simply just cannot. You're forced to stay in the market that you're trying to exit. So the risk can be higher. And last but not least, DST can be applicable to all of the United States assets, real estate, property, business, stock, crypto, or what have you. With 1031, it is only applicable to investment or rental properties or commercial real estate. Let's take a look at the DST Trust investment options. Typically, we have in-network and out-of-network investment. With the in-network investment, money can be invested into ETF, mutual funds, stocks, bonds, and etc., which is more liquid. And out-of-network investments are typically along the lines of real estate. Let's say if you wanted to take the money out and start flipping houses, or you can buy businesses such as I want to buy a McDonald's, I want to buy a car wash, whatnot, or you can use that money to invest in life insurance, annuities, and etc. That's called the out-of-network. And the requirement is that 25% of the money must stay as in-network as liquid asset. Now, withdrawing money from the DST Trust. Now, obviously, DST Trust is very liquid, and you can withdraw the interest that you earn, or you can also start touching the principal in the DST. If you're withdrawing just the interest, you'll pay the ordinary income tax. But if you're touching the principal, then you pay a capital gain. So the percentage completely depends on what tax bracket, and that is based on the amount that you withdraw every year. You can decide whether you want to take out more money or less money and decide what bracket you're in. But the bottom line is 100% of the control is back to you. In summary, DST is like an IRA account. You can roll over your highly appreciated assets and restructure your future investment with 100% control. This is what's nice about DST. So let's take a quick look at the DST operations. So there's typically three components to it. The first one is an estate planning and tax attorney team. This group of people help you set up the DST and charge you a one-time fee. And then there's the DST certified trustee company. This can be considered the quarterback of the entire operation. And this is the party that's responsible for, after the DST is set up, and the maintenance, the ongoing maintenance of the DST. And then thirdly is the wealth and financial advisor. This group of people are the ones who's going to help you with the money that are in network in your DST and help you generate more income and interest while the money is in network in the DST. So what is the cost of DST setup? Well, let's take a quick look at it. So there are two fees. The first one is a one-time fee of 1.5% of the first 1 million in the sale price and 1.25% of the sale price, which exceeds $1 million. If your sale price exceeds $10 million, then it becomes a negotiable fees, percentages. And then there's also a annual 1 to 1.5% of the in-network fee. That fee is typically paid with the interest that you earn as the money is sitting in network. Say if you're getting a 5% return annually, then this 1 or 1.5% of the fee will be deducted from the 5% that you earn. That's just an example. So let's just take a quick example of, let's say, the cost of DST with the $1 million gain. So with the regular straight sales, there's no planning, nothing involved. And then there's another scenario with the DST planning, 1.5% cost. So with the straight sales, you take the $1 million gain, deduct 30% tax. What you're left with is $700,000 that's left in your pocket. And then with the DST deferral plan, $1 million that you're going to be deferring it into a DST, you pay a 1.5% cost, and that gives you $985,000. So it's about $15,000 a one-time fee. And then with the straight sales, you invest the $700,000 yourself into Charles Schwab or Merrill Lynch or whatnot. You get, let's say, a 5% annual interest. That translates to $35,000 annual. And with the DST, the pre-tax amount is $985,000, and you invest the same way, and you're making a 5% annual interest. That translates to $49,250. It's about $50,000. Basically, first year, the cost of DST, which is $15,000, is breaking even with the extra income earned from the DST. In this case, you take the one on the right-hand side, which is close to $50,000 compared to the $35,000 earned with no tax planning. You're basically earning $15,000 extra, and the cost of DST is $15,000 one time. So the first year it breaks even, but going forward, DST will be able to earn additional $15,000 extra each year. So now let's talk about the suitability of DST. What are the ideal candidates to use DST to defer their trust? First, due to the costs that we previously discussed, it is ideally for anybody with $250,000 or more in tax liability. Secondly, any assets that cannot qualify for 1031. Let's say if you own a primary home, like we have a lot of these in California where people purchase a primary home 20, 30 years ago in San Francisco Bay Area for $500,000. And now in the year of 2022, that same property is probably selling for $2 million, and you have a $500,000 tax exemption, but you're still going to be paying tax on $1 million capital gain. And you can't even do a 1031 because it's your primary home. So that's an example. And there are other examples, such as like if you own restaurants, if you own like car wash, if you own like stocks, crypto, they're highly appreciated. These are all assets that cannot do a 1031, and they can be a great candidate for DST. And this can also be a great 1031 rescue plan. Like I said previously, about 20% of the 1031 deal falls apart whole nationwide. So DST can always be a backup option in case if the 1031 doesn't work. If you're backing out of this purchase with your 1031, you already missed that 45 days. So now, you're already halfway into your 180 days to close. If you can't close, what do you do? So DST can be a great way to rescue the 1031. This can also be a great exit strategy and retirement planning for landlords and real estate investors. And, I know a lot of landlords and real estate investors that have done really well investing in real estate in their younger days. But at some point in their life, they no longer wanted to be landlords. They no longer want to deal with tenants, calling them in the middle of the night. And these are the people that if they do 1031, they'll continue to have to become landlords. But DST can be a great way for them to exit this cycle and invest their money into something else that generate them a good retirement income. So it's a great exit and retirement planning strategy. And this is also a great strategy for LLC, S Corp, C Corp partners. So a lot of the real estate investments are done not by the individuals, but rather by partners. So years down the road, if for some reason not all the partners are on the same page anymore, some partners want to continue investing in real estate and some other partner just want to cash out and leave, DST can be a great way as an exit strategy for partners to part away. Let's talk about DST's frequently asked question. There's a couple of these questions that have always been asked when it comes to the DST's topic. First one is, can I use money in DST trust to buy primary homes? The answer is no. The money in the DST trust can only be used to purchase anything that's an investment. You cannot purchase anything for your personal use, such as primary home, such as a nice car, such as like jewelries and diamonds for yourself. So the short answer is no. Now, what will happen to the money in DST if I die? So that's a good question. It all depends on how you design your will. So an easy way to understand is, let's first, you have a DST trust, okay? And then here's you. And then, here's the money that's coming in from the DST trust account into your account. Everything has been set up properly. So that's what we have to begin with. And let's say one day the seller and the investor were to leave us. What's going to happen? Well, the money that's in the trust will forever be in the trust in the tax deferred state. That's one thing about the trust. Once it's completely set up and it's done right, it will automatically be operating with or without the attorney or the grantor or whoever. And it's a legal entity recognized by the government. So as long as the money is in the trust, it'll forever be in a deferred state. So now the question becomes, if you continue to take the money out when the investor or the seller is no longer with us, well, then it really depends on what the investor's estate plan is. It will determine who will take over the control of the DST trust fund. So typically, a lot of the investors, after they set up the DST deferred strategy, they would also, while they're still alive, of course, set up their estate planning, maybe by creating a revocable trust or a living trust. This is going to determine how their money is going to travel from the DST trust into their personal account. So this, to answer the question, this is more of the estate planning question after the DST is set up. how long is the promissory note between me and the DST? The answer is 10 years, and then it can be renewed for another 10 years and so on. So as long as you keep on renewing it, and as long as you have a proper estate plan, the money sitting in the DST can be in a tax deferred state for generations once everything is set up and done right. And when should I start the process when selling my assets? Well, the answer is as early as you can. Once the sales is finalized and closed, the tax is triggered. It will be too late. So if you decide that you wanted to sell your asset, you should always start consulting with experts sooner rather than later. If DST is so good, how come my CPA doesn't know about it? So, like I previously stated, DST is a proprietary product that only a dozen of certified companies are allowed to provide such services. It is highly specialized service. Most general tax and law practitioners don't know. All right, that's it for the DST and basically how it works. For more of your unanswered questions, feel free to comment down below or feel free to reach out to me. My contact information is also in the descriptions. Now, if you like this video or find this video helpful, I would greatly appreciate it if you can subscribe and like my channel and hit the notification button. All right, talk to you next time.